Well, welcome to Oxford Business Leaders. Today we've got Steve Baker speaking for 10 minutes about his business and how he helps people. Steve is a extremely well qualified financial advisor who's got many years of experience and traditionally has clients who stick with him for an amazingly long time. So Steve, over to you. Do tell us about who you are, what you do, and how you help your clients.
Well, in fact, what I'm going to do today is not promote my business. I'm going to hopefully educate you into an asset. Everybody on this who's attending this meeting today, they have this particular asset, and people don't realize how valuable it is. And there are steps that you need to take to make sure that you protect that asset. But as Alan says, just very, very briefly, I am an independent financial advisor, close on 32 years experience. Very, very close to obtaining chartered status as well. So I'll press on. What I'm going to talk to you about today, you might be surprised, it's your state pension. Unfortunately, the state pension has been subject to constant tinkering over the years, not necessarily for the betterment of the state pension. A lot of it was political tinkering. I won't go into the history too much because I'm conscious of the time and there's various points I want to get across to you to help you. I hope you've got a notepad and a pen with you, because there's some things, if I'm not going to share slides with you because I'm not creative with IT, but I'm going to impart some very important information which you might want to jot down. But just to tell you, the first state pension that was announced, which was then for the over 70s, was announced in 1908 and became operative in 1909. But you can imagine life expectancy in those days. The state pension didn't really pay out a lot. So it's changed throughout the years. We've gone through many different changes. We've had graduated pensions. And then the idea was that you've got a basic state pension, and by paying additional national insurance contributions, you could add to the state pension, bringing you more up to date. This is a term you've probably heard, seen somewhere, SERPS, which was launched in 1975, the State Earnings Related Pension Scheme. Now, the interesting thing, and this will impact upon what I'm going to say later, people were actively encouraged to contract out of SERPs. And the irony of it all is, financial advisors went out and helped people to contract out, and then it became known as a mis-selling scandal. So people were then encouraged to complain, but that's another story. SERPs was replaced on the 6th of April 2016 by the single tier pension. No, we had the second state pension, I do apologize, and now we're on what's called the single tier pension. So here we go. These are the important bits. That's just a very brief background of state pension. The maximum pension you can get at the moment is £179.60 a week. And there's a bit of a contradiction in terms, so you can get more, but I'll come on to it. But in simple terms, it's £179.60 a week, which is £780.94 a month, which is £9,371.27 a year. And of course, if you're married and there are two of you getting that, that's £18,742.54. That's a pretty valuable asset, because when you think about spending in retirement, 18 grand between you is pretty much going to cover the basics for you, I would suggest. This is the first thing I urge you to do this. If you want to make a note of this, go onto the government website, www.gov.uk/check-your-pension, and complete what's called a BR, Bravo Romeo 19. Now, what they will do there, they'll do two valuations for you. Let me start off by telling you, under the old system, you needed to have made 1 year's full national insurance contributions to get any form of state benefit, and a maximum of 30 years. Under the new system, which is not as good as the old system, I have to say, you now need a minimum of 10 years and a maximum of 35 years. So if you do your BR19, it will highlight any shortfalls in your national insurance record. I mentioned earlier about SERPs. I speak to people and they say, I'll be fine because I've been paying national insurance for 38 years or whatever. When you check into it, they were contracted out for a period. So that's going to have a knock-on effect to the amount of money they get at the back end. Now, what you can do is you can make up gaps in your national insurance record. You can pay what's called 3A, voluntary 3A national insurance contributions. If you do that, it's going to cost you £15.40 a week, which is £800.80 a year. Now that sounds a lot, doesn't it? It isn't. It is a bit of a gamble. If you pay that and die prematurely, they've won, the government have won. If you do that and live till you're 150, you've won. But let me tell you, this is such a valuable asset that you've got, your state pension. If you were to go out now with money into the open market and buy what's called a purchased life annuity, to get a pension that's going to pay you £179 a week, index linked for the rest of your life, you would need a pot of £300,000. So if that's a joint pot that you're going to accrue, that's £600,000. That's a hell of a lot of money you need to buy what is an incredibly valuable asset. And don't forget, this is double locked. It was triple locked. It was never going to remain triple locked, but it's double locked. So that amount of money is going to increase by consumer price index, CPI, or 2.5%. This is capped at 2.5%. They were also linking it to national average earnings, but last year it meant that the state pension would have had to have increased by 8%. There's no way that they were going to do that. So the national earnings part of it has been removed. It's now double locked, not triple locked. Another important point I want to bring out here is people think you need to be employed or self-employed to claim national insurance credits. You don't. So you may have family who are doing some of these tasks and you'll be able to help them. If you're caring for somebody for 20 to 35 hours per week, you can claim national insurance credits. If you're performing jury service, you can claim national insurance credits. If you're caring for a child under the age of 12, you can claim national insurance credits. If you know somebody that's living abroad with a spouse in the military, serving in the military, they can claim national insurance credits. And even if you're unemployed, looking for work and can prove that, you can claim national insurance credits. And it's really important that people do that. Another point I'm going to make here, you can defer taking your state pension. Now, under the old system, which was better, you could defer in blocks of 5 weeks at a time. And it used to be equivalent, every 5 weeks that you deferred, it would be the equivalent of adding 10.4% to your state pension over the course of the year, 10.4% per annum. Now, unfortunately, you have to defer for blocks of 9 weeks at a time, and it's the equivalent of adding 5.8% to your state pension. There's a good point here. It's a broad brush statement, but don't defer taking your state pension. Take it. If you're a higher rate or an additional rate taxpayer paying 40% or 45%, I agree, it's then probably worth deferring, taking it. If you're a nil rate or a basic rate taxpayer, which a lot of people will be by the time they come to retire, take the money. If you defer, I know you're increasing the amount of money that you're going to be paid, but it's been calculated that the break-even point on that is 17 years. You suffer something called loss of use. You haven't got that money available for you to use. So it's not written in stone, but the word there, that the advice is take the pension. Another thing I'm going to highlight here, this is an acronyms, I should say, sorry, and people see it on their statements, and it's COPE, C-O-P-E, stands for Contracted Out Pension Equivalent, and it confuses the heck out of people. People think, when they look at it, they think they've been given a figure, what the estimate is of their pension, and they see this figure in COPE. I need to be quite blunt about it. The figure you see stated in COPE is not worth the paper it's written on. It's an estimate. Once upon a time, when you contracted out the service, it created something called protected rights, and it would only create income for you. Then we went through something, and we have, which is generally called a pension account. So it'll now produce tax-free cash. You can take 25% of that protected rights pot as tax-free cash if you wish, and an income, or you can access it all, and you can access it all from age 55. The Department of Work and Pensions have no idea if you've accessed that money or not. So all COPE is a guesstimate of what that amount of money is that's been added to, but it's included, it's part of the pension estimate that they've given you on the pension statement. COPE is not an addition, so you need to be aware of that. And again, if you have friends or family that are looking at that, you see the word COPE, disregard it. It is pointless, and it confuses the heck out of people. just quickly, I'm conscious of the time. You don't inherit in the event of death now under the new system. There are no death benefits for spouses. And what you can do is really, really simple. Bear in mind, £179.60 is the maximum you can get. You can quickly work out, if you know for certain, for example, keep the math simple, you've got 32 years of national insurance contributions, multiply the 179.60 by 32, divide by 35, you know I'm going to get £164.21 a week unless I boost the national insurance contributions that I can by making voluntary class 3 national insurance contributions. And I'm being told by Alan I need to wind up. So that's exactly what I'm going to do.
Lovely. Brilliant. Thank you